Good morning and welcome to TOPIX Japan Market Radio for Wednesday, March 11, 2026. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japanese equities, currency, and rates, bringing you the key developments shaping Japan's markets today. Let's dive straight into today's session.
Thanks for having me. Today's session painted a broadly positive picture for Japanese risk assets. The Nikkei 225 closed up 1.432% at 55,025.371, while the TOPIX gained 0.936% to close at 3883.0. We also saw strong performance in the Mothers Index, which rallied 2.075% to 2,509.0, and the J-Right Index added 0.984%, closing at 2000.5. On the currency side, dollar-yen traded at 158.509, up 0.419% on the day. Commodities showed interesting divergence, with gold in yen terms rising 1.059% to 19,560.0, while crude oil surged 5.333% to $87.90 per barrel.
That crude oil move certainly stands out. Before we get into the energy story, let's talk about what drove today's equity rally. The headline making waves globally is Nintendo's extraordinary performance following the launch of a surprise hit Pokémon game. Shares reportedly jumped around 10% in the session. Can you walk us through why this matters beyond just one stock?
Absolutely. Nintendo's rally is significant for several reasons. First, this is one of Japan's most globally recognized companies with meaningful weight in both the Nikkei 225 and TOPIX. When a stock of that scale moves 10%, it provides genuine mechanical support to the headline indices. Nintendo carries roughly 2% weighting in the Nikkei, so today's move alone contributed measurably to the index performance. But beyond the arithmetic, this speaks to franchise strength and the company's ability to monetize its intellectual property portfolio.
And that IP monetization angle is particularly relevant for Japan's broader digital economy ambitions, isn't it?
Exactly right. Nintendo generates substantial export revenues in foreign currencies, which supports Japan's current account balance. More broadly, successful game launches like this one boost domestic investor sentiment toward Japanese equities, especially in the consumer discretionary and technology sectors. It's a reminder that Japan still has globally dominant franchises capable of driving meaningful earnings surprises. For equity investors, this kind of news tends to improve sentiment for cyclical and growth-oriented sectors beyond just gaming.
What about the implications for currency and rates? Does a strong Nintendo performance feed through to the yen or Japanese government bond markets?
The impact there is more modest. In theory, strong corporate earnings can support yen repatriation expectations, which would be yen positive. However, this is essentially a single stock event, so the near-term currency impact is limited. For JGBs, improved equity market sentiment can modestly reduce safe haven demand for longer duration bonds, but any yield movement would be marginal absent a broader shift in monetary policy expectations or macroeconomic data. The real story here is equity market psychology rather than macro asset repricing.
Staying with equities, today's broader market strength was notable as well. Reports indicate the Nikkei surged 2.88% with an advanced decline ratio of 8.13 times, and Lasertech led the gainers. That advanced decline ratio is quite remarkable. What does that tell you about market internals?
An 8.13 times advanced decline ratio is exceptionally strong and signals broad-based participation across the index. This isn't a story of narrow leadership concentrated in a handful of mega-cap stocks. Instead, we're seeing genuine underlying optimism and investor appetite for Japanese equities more broadly. That kind of breadth is healthy and suggests the rally has some durability rather than being driven by momentum chasing in a few names. Lasertech's outperformance is particularly relevant given its exposure to semiconductor manufacturing equipment. That sector remains critical for Japan's tech export competitiveness and ties into global chip demand trends.
So this isn't just a Nintendo-driven rally, it's a risk-on move across the board. Does that kind of sentiment have implications for the yen or bond markets?
It does, though the effects are typically modest. Risk-on sentiment in equities generally pressures the yen because it reduces safe haven demand. Today's rally could contribute to mild yen weakness, though broader macro factors like Bank of Japan policy and global interest rate differentials remain the primary drivers. On JGBs, equity strength can support higher long-duration yields if investors rotate from bonds into equities, but this effect is usually subtle unless the rally reflects genuine inflation or growth expectations rather than just momentum.
Now let's turn to that crude oil move you mentioned at the top. Oil surged over 5% today amid reports of escalating tensions in West Asia. For context, Indian equities fell nearly 2% on the same concerns. How should global investors think about this development in the context of Japan?
This is a critical story for Japan. Japan is one of the world's largest oil importers and heavily dependent on Middle Eastern crude supplies. A 5.333% surge in oil prices directly increases import costs and adds to inflation pressures on the Japanese economy. The geopolitical backdrop here is also important because it creates a broader risk-off tone across Asian equities. We saw that clearly in India today, and Japan's export-dependent sectors are vulnerable to the same sentiment shift. Energy-intensive industries like shipping, chemicals, and materials will face margin pressure from higher input costs.
So there's a direct hit to corporate profitability in certain sectors. What about the macro implications for the yen and rates?
The yen dynamics here are interesting and somewhat contradictory. On one hand, geopolitical risk-off typically supports the yen as a safe haven currency, so we could see near-term yen strength. On the other hand, sustained higher oil prices worsen Japan's terms of trade because the country imports nearly all its energy. If elevated oil prices persist, they could eventually weaken the yen by increasing the current account deficit and creating stagflation concerns. For JGBs, if equities sell off significantly on energy shock fears, we'd expect investors to rotate into defensive fixed income, putting downward pressure on yields. However, long-term yields are likely to remain anchored given the Bank of Japan's ongoing yield curve control framework, though near-term volatility is certainly possible.
So in the near term, the yen might catch a safe haven bid, but the longer-term picture is more challenging if oil stays elevated.
Precisely. Geopolitical energy shocks typically create near-term headwinds for Japan's equity markets and add to inflationary pressures. The yen's initial reaction may be supportive due to risk-off flows, but the structural impact of higher energy import costs is yen negative over time. For equity investors, sectors like energy and transportation would underperform, while defensives and domestic-focused names might show relative resilience.
Let's bring this together for our global investor audience. Today we saw strong domestic equity performance driven by Nintendo and broad market participation, but also a significant energy price shock from geopolitical tensions. How do you reconcile those two narratives?
It's a reminder that markets can hold multiple truths at once. Domestically, Japan's equity market showed genuine strength and breadth today, supported by positive corporate news and healthy investor appetite. At the same time, the external environment is introducing new risks via energy prices and geopolitical uncertainty. For global investors with Japan exposure, the key is to monitor whether the equity momentum can sustain in the face of rising input costs and potential risk-off sentiment across Asia. The next few sessions will tell us whether today's strength represents a durable shift or simply a pause before energy concerns weigh more heavily on risk assets.
And on the currency side, it sounds like the yen remains caught between competing forces.
Exactly. Safe haven demand versus deteriorating terms of trade is the central tension. In the near term, risk-off flows could support the yen, but structurally, higher oil prices are a headwind. The Bank of Japan's policy stance remains the dominant factor, and any shift in yield curve control or forward guidance would overwhelm these more tactical considerations.
Before we wrap, any final thoughts for investors tracking Japan today?
Today's session demonstrated both the opportunity and the complexity of Japanese markets. Strong corporate performance and broad equity participation are positives, but external risks from energy and geopolitics require close attention. For those with existing Japan exposure, it's worth monitoring sector rotation, particularly out of energy-intensive industrials and into domestics or defensives if oil remains elevated. And as always, keep an eye on Bank of Japan communications for any hints of policy adjustment.
Great summary. Thank you for breaking down today's developments. For our listeners, if you're tracking Japan's equity, currency, and rates markets, consider subscribing to stay updated on the key drivers shaping investor sentiment. We'll be back tomorrow with another edition of Toy Japan Market Radio. Thanks for listening.